return, whether it's the LLC or whether it's the individual who owns the property, or corporation, trust, limited partnership, all those in green that you could see on the side. The bottom line is that is the owner of the property, but really that isn't what the government looks at. You know what they look at? They look at your social security number or the EIN number or the TIN number. They want to know who is the taxpayer. You are not known by name to the government. You're known by a number. That's what you are. That's what I am. So the bottom line is that the tax ID number that sells in a 1031 exchange has to be the tax ID number that buys. Now, if we sell this property in an LLC, well then the LLC will buy because it's the same tax identification number. If I sell as an individual, or my wife and I as husband and wife as community property, can we buy in a trust? Or better yet, if we sell in a trust, can we buy as individuals to get better financing? Or maybe the lender won't even lend to a trust. The answer is, well, again, the government doesn't look at title as much as they look at the tax ID number of the ones who own title to the property. Now, in my case, my wife and I own, let's say, this property in our trust. But really, we can still buy in our names as individuals. Why? Because our trust tax ID number is our social security number. So in other words, even though I'm going from trust to individual or individual to trust, I can do it. Why? Because the tax ID numbers are identical. It's our social security numbers. So the bottom line is the social security number or the tax ID number has to maintain from sale to purchase. Now, what happens if I have, there's two kinds of LLCs. And this may be going a little deeper than you want to go today, but I'd like to talk about it because it just happens. There's two kinds of LLCs. One's called a disregarded LLC. There's a second kind of LLC. It's a non-disregarded LLC. So it's regarded or not disregarded, or regarded or disregarded for what? For tax. Let me explain. If we were to buy if I own as an individual, let's say, a property, and I set up an LLC for limited liability protection, I have two choices. I can put that LLC under my social security number. So it has an LLC protection. I can still shelter myself from lawsuits or whatnot. But the bottom line is it doesn't file its own tax return. Why? Because it has my social. So that LLC becomes that disregarded LLC is disregarded for tax filing purposes, and it files its tax return through my personal return. Does that make sense? That's called a disregarded LLC. I can do a disregarded LLC one of two ways. Number one, as an individual, or number two, as a married couple in a community property state. If your property is not in a community property state, then it doesn't qualify for a single disregarded LLC. It will not work. It has to be either an individual with its own tax, with my social security number, or if it's a husband and wife, we're both on title in the LLC under our social security numbers, we file a joint return, then we can utilize it as a disregarded LLC. What is not a disregarded LLC? Well, if I bought a property with Cheryl and her husband, or with Julie and her husband, the bottom line is that we're not married, all of us, right? And then, so we have to set up a regular non-disregarded LLC for the ownership of the property, which will what? File tax return every single year. Now, so does the vesting need to stay the same? Well, it depends. It's better if it did, but if it cannot, the real test is what? The tax ID number. And what is the tax ID number? Because the tax ID number sells has to be the same tax ID number that will acquire the replacement property. Oops, it's going the wrong direction. Okay, so let's say we bought the property in an LLC as an example, and we have Cheryl and her husband, we have Julie and her husband, and my wife and I. We're all shareholders of the LLC. So the question is, we would like to sell, and we've decided not to reinvest with each other. We want to go separate ways. Can we do that? So can the LLC do a 1031 exchange? The answer is, well, again, who's the owner of the property? The answer is the LLC, not us. Why? Because we don't want to be sued. So the LLC is the owner of the property. We're just the shareholders. So the question is, can we split up and go our own separate ways and exchange or not exchange? The answer is yes, but it's really a pain. And I'm going to show you how you do that. One's called a drop and swap. The other one's called a swap and then drop. Okay, what's a drop and swap or a swap and drop? Well, I can tell you what it's not. It's not the California marriages. A lot of people think in California we swap and drop partners here, and they think that's what it is. That's supposed to be a joke. I hope you're laughing because I can't tell. But the bottom line is that the swap and drop and swap is how the federal government and the state of California look at our LLCs. Many times I'll get a phone call, and the phone call I will have will tell me that the person says that, well, we want to do a 1031 exchange. I say, sure, not a problem. How do you own the title to the property? Well, we're part of an LLC. I said, well, is the LLC actually doing the exchange? No, we want to go separate ways. Well, then you only have two choices. One is called a drop and swap. Are you currently in escrow? Yes. Well, drop and swap will not work for you. Why? Because in a drop and swap, you have to dissolve the LLC and hold title as tenants in common for 24 months, for 2 years, before you enter into a sales agreement on that property. We're already in escrow. Guess what? We're already into a sales agreement. And number two, that buyer's not going to wait around for 2 years. So the bottom line is drop and swap won't work. Drop and swap is preventative. So if we think that in a couple years or 3 years or 4 years or 5 years down the road, we might separate, we might hold title as tenants in common. My wife and I can have an LLC, or we can put it in our trust. Julie, Cheryl, same thing with them and their spouses. So we could have tenants in common. Maybe one's an LLC, one's a trust, the other ones are just individuals. It doesn't matter. But we're tenants in common now. And once we dissolve it and hold it as tenants in common, we have to wait for 2 years. And then we could go ahead and sell and go our own separate direction. Maybe Julie and her husband doesn't want to do a 1031 exchange. Maybe they just want to cash out. But then you know, the rest of us want to go ahead and do our own 1031 tax deferred exchange. Cheryl wants to do her separate, I can do my separate. So the bottom line is we can do that under drop and swap, but you have to wait for 2 years after you dissolve the LLC. The other issue with wanting to do a 1031 exchange and go separately is called a swap and drop. This one's a little more technical. It's tough if not everyone is on board and doing their own 1031 exchange. So let's say, for example, we sell the property and we get a great offer, we can't turn it down. We want to sell the property, but it's in an LLC with 6 different members, right? So what happens is the LLC can actually sell the property in the 1031 tax deferred exchange, and then the LLC will buy the replacement properties. Now, the LLC will buy a property for Julie and her husband, for Cheryl and her husband, and for my wife and myself. So the bottom line is the LLC will swap and then retain title to the new properties for, you got it, 24 months, 2 years. And then after the 24-month period, the LLC will dissolve itself, deed Julie's property to her and her husband. The property was holding that was going to be Cheryl's and her husband, it will deed it to them. And then my property, mine is going to be the best one, right? It's going to be in Paso. But in that area. Anyway, the bottom line is, so we'll have a place to stay when we go up there. But the bottom line is that it will acquire a property for us. We'll dissolve the LLC, and that's how it's swapped first and then dropped after 24 months. This is really important. Now, just remember, if you're holding title with a sibling, if you're holding title with a friend or some kind of relative, the bottom line is that through the LLC, remember, you're probably going to have to do the drop and swap or the swap and drop, because it is not going to be a disregarded entity, that LLC. It's going to have its own separate tax ID number. Let me give you one more situation, then we can put this puppy to bed unless you have any questions. And this happens on a regular basis in the 1031 exchange world because of all the liability and everything that people are trying to avoid by putting their properties into LLCs. By the way, it costs them an extra $800 a year to file that LLC with the state of California. So it's not cheap. But the bottom line is, let's say Cheryl and her husband doesn't want to exchange. Julie and her husband does, and I do with my wife. So the question is, can we do the swap and drop? The answer is, well, since they want out and they want to pay taxes, the problem is we have to keep that LLC intact. So what'll happen is that either Cheryl will buy, well, Cheryl, you're not exchanging, right? So in this case, no, it's Julie who's not exchanging. So Cheryl, you can buy Julie's shares of the LLC, and that will be a taxable event to Julie. Or I can buy, Julie's shares of the LLC for whatever the value is worth based on the property it's holding. We can do that as well. So now the two of us, or the two couples, are shareholders now of the LLC, as opposed to three couples as shareholders. But if neither one of us can buy each other out, guess what happens? We're going to have to sell the property and pay taxes. There's no way out of it. This is a huge problem. And this is the only solution that I'm aware of that can fix this problem. Now, having said this, does anybody have any questions? I'm afraid to ask. Anybody any questions on this, because it's a big deal?
Phil, I was just going to ask the question. So, we always look at, for regular residential property, the 2 out of 5 year rule. Does that still apply? Is that what the 24 months is coming from, is for the taxable event?
No, it has nothing to do with it. What you're referring to is the 121 principal residence exclusion.
Okay.
That's only in your principal residence.
Okay.
There is a debate among some tax people that it should be a 24-month hold, whether it's a swap and drop or drop and swap. Some tax people feel that 12 months will work. I'm here to be a little bit more on the cautious side. But if your CPA or your tax attorney feels comfortable with 12 months, and then for some reason they get audited, then the bottom line is they're going to have to speak to the auditor, and the tax counsel is going to have to defend that situation as to why it was 12 months as opposed to 24 months. So it's debatable among some ranks, some tax people, some attorneys, but find out what you think is best for you. Again, I just put in the more conservative way, the more cautious way of going, and hopefully your tax people will give you the clarification that you need to be able to understand this and take what approach is necessary.
Thank you.
You're welcome. Any other questions on this before we,
I do.
Yeah, go ahead, Charlotte.
Hi. So I'm just wondering, when you do this, let's say they divide up, and for the 24-month period, does it have to be a rental of some kind, or could, let's say, like you were saying, you'd buy a property in Paso so you could live in it. Could it be a second home that you would purchase, and then, or do you need to, for those 24 months, have to show income from, renting situations to show that it was a like kind property?
Charlotte, that's an excellent question. So excellent that you became a mind reader, because as soon as I said that, I thought of your question, and I said, well, technically that's not true. I can't live in it. you know, or
Okay, that's what I was a little confused.
let me tell you, I don't know if you know this, and this could be part of our technical class today. Did you know that when you buy it has to be a rental property, it has to be investment property. It cannot be a second home, it cannot be a vacation home. I will tell you this, the government will allow you to utilize it for personal use for 14 days a year or 10% of the time it's rented. And they'll give you whichever one is greater. So if it's rented for 140 days a year or less, then I can only take a maximum of 14 days a year. If it's rented for more than 140 days a year, like let's say 200 days a year, for example, then I can take 20 personal days. But that's all the government will allow me to take. So yes, I can live in it for a little bit, but it has to be a what? Investment property. Because remember just when we first began, what is like kind? It's the sale of what? Rental or investment property, and it's the purchase of rental or investment real estate.
Yeah, I was just confirming that. So after the 24-month period and you've dissolved your relationship with your LLC and the other partners, can you at that point turn the property into a secondary house?
Okay,
is that something that's legal to do?
Okay, I actually have a slide for that that's coming up.
Okay, sorry.
I'd like to deal with it when we get to that slide so you can see it, not just hear it. I promise we'll go back to it again. All right.
Thank you.
And if I don't, hold my feet to the fire so we won't even log off without attacking that today, because that is a very important question. It's actually, and I speak at between, well, this year it's going to be closer to about 175 times on Zoom and whatnot. But prior years when I'm just out speaking physically, it's usually about 130, 140 times a year. And the bottom line is that's the number one question I get out of all the questions that are out there. That's a good question.
I have a quick question. So when should an individual put their real estate holdings in an LLC versus the other ways to hold title? When they own 2 properties or more, or 3, or does it matter?
Well, the question is, how much liability do you want to protect, you know, from your personal assets? Because what if you lived in Franklin County where you have a $2.5 million piece of property and you have other real estate? Well, you would probably want to set up an LLC, but here's the problem where a big mistake is made, Cheryl, and that's a very good question. You know what the big mistake is made? They set up an LLC and then they put multiple properties in that. Well, guess what the LLC now owns? Multiple properties. So now if they sue you, they can take all your properties away because all those properties are in the LLC. That doesn't make sense. You'd probably want to set up one LLC for each property. Now you could pay it to the state of California in terms of $800 a year, you know, for each LLC, and or you can pay a lot of money in liability insurance with your insurance company. You know, that would be like a over covering, like a I don't know why I can't think of it. Not a flagpole,
like an umbrella policy.
Yeah, like an umbrella policy, exactly. So. The question is, will that give you enough insurance for that situation? Everybody's situation is different. They should consult with their CPA, and I hope their CPA understands this. If they don't, you probably want to talk to a tax attorney who specializes in real estate, and also talk to your insurance people and see which one would be best for you.
Thank you.
It's all about liability. It's all about protection, isn't it?
You can set up LLCs in Delaware for cheaper, I believe.
Yeah, but the problem is that you really need to set up, and this is where your tax people come in, especially your tax attorneys. You really need to set up an LLC in that state that the property's in. Not a California LLC, not a Nevada LLC, not a Delaware LLC. I've read way too much information that really prohibits that. So go have counsel with your tax people. See what they recommend. I know you can do it for cheap, but the problem is, if it doesn't give you what you need in the event there's a problem, you've got a really big problem on hand, and you don't want to get stuck in that. So that's my recommendation. Anything else about drop and swap? All right. Now we're going to be talking about what's qualified and not qualified. This is really important because a 1031 exchange isn't qualified by virtue of the fact that the accommodator did it. we have to do it. That's part of doing a 1031 exchange. You have to engage with a qualified intermediary, an accommodator. But the bottom line is, it doesn't mean that what you're doing is right. And I want to explain what some of those pitfalls are that the feds and the state of California look at. May I exchange funds into a properties I just exchanged to do improvements in? So for example, let's say I sell a property here in the city that I live in, which is, let's say it's a rental in the city of Whittier. And let's say I want to buy a rental in Paso. I'm thinking about that wine thing today. So I do an investment property up there. The question is, after I acquire my new Paso property, can I take the exchange funds, hold some back, and then put them into repairs and improvements on the acquisition? The answer is no. Why? Because in a 1031 exchange, that means 100% of the cash from the sale has to go into the acquisition, other than non-recurring closing costs. That can come from the proceeds of the sale. So I can pay for commissions, escrow, title insurance, transfer taxes, recording fees, and exchange fees, and anything I've negotiated with the buyer to pay for that I've agreed to because of an inspection report or things that they want done to the property that I've agreed to, I can pay for those because it's a contractual condition of sale. It's allowable. But the rest of the cash has to go into the acquisition. The acquisition, not a day later in terms of doing improvements or paint or carpet or whatever to the property. So any cash that goes into it later is boot. And I get this question a lot more these days. Why, I don't know, because my client base is all over the country, but I've obviously more in California than I do all over the country. This is a big question right now. And the answer is all the cash has to go into the acquisition. Can I keep some of the cash to do those items? Yes, but you will pay tax on the money you keep. So if that's what you want, make sure you let us know, and we'll set up your exchange in such a way that you can get cash afterwards at the end of the exchange period and pay taxes on the money. But I will tell you this, it's probably going to be a lot less money for you to get a quick second on the property, take a little equity out and fix it up then, because especially with how low interest rates are, it's far less expensive than paying taxes, and keeping some cash back to fix. That's my humble opinion. Talk to your CPA. Next, can I pay off a loan on a property I already own? I had that question again yesterday. I want to pay off a loan on my home or on a different rental. Can I pay that off with the sale of my investment property? The answer is yes, but you're going to pay taxes on it. So really the answer is no. You can't do that because all the cash from the sale can't be paying off other loans on other properties you already own. It all has to go into the acquisition. Next question. May I purchase property I currently already own? The answer is it depends. For example, let's say Cheryl and I own a property 50-50 and we're selling the property for $500,000. So technically I own $250,000, she owns $250,000. Let's say I sell another piece of property I own for $250,000. Can I buy Cheryl's half and do a 1031 exchange from the sale of the other property I own to the other half of the property I'm selling for $500,000 that I own with Cheryl, but I don't own her half? The answer is yes, I can buy Cheryl's half out and do a 1031 exchange into that. But if I owned 100% of the property, I can't do a 1031 exchange on a property I already own and to buy into that. A lot of people ask me this question: can I do a 1031 exchange into vacant land that I already own and build a building on there? Or can I do a 1031 exchange and build a building on my home and build an ADU, for example? Do you folks have ADUs up there? I know we have a lot of those down here in LA, the accessory dwelling unit. That's when you could start renting.
Yes, lots of them.
Unit. Do you have that? Okay, so the bottom line is that can I do that? The answer is no. Why? Because an exchange is a sale and a what? Purchase. So if you're not selling and buying property, investment property, like-kind property like we spoke of earlier, then it's not a 1031 exchange. is simply a taxable sale that you're utilizing to build on land you already own. So you can't do it, or as my cousins on the East Coast would say, forget about it. The answer is no, you can't do it. Next, can I exchange from or into a leasehold interest? Is that qualified under a 1031 exchange? So let's say I have a leasehold interest on a piece of property and I've got 20 years left on that lease. Can I sell that property with that leasehold and sell that interest that I have and do a 1031 exchange? The answer is yes, but if it's an only 15-year leasehold, I have to acquire another 15-year lease. However, if I'm selling a property where there's a leasehold interest on it, and that leasehold interest has 30 years or more remaining in the lease and or its extensions, that's very important, and or its extensions, then the government considers a 30-year leasehold as real property. I can sell that leasehold and buy investment real estate that I take title to myself. And the government will let me do that because 30 years or longer with a leasehold interest with its remaining lease and extensions equals real property to the Internal Revenue Service. And they'll allow you to do a 1031 exchange into real property that you buy and hold. That makes sense? You know where we see a lot of that? These cell tower places or billboard places that you will lease property onto, and they want to be able, they've invested in that and they want to do a 1031 exchange and to go to something else. So can you do that? The answer is yes. Oh, here's a question you just asked for. Can I move into my new property after I do the 1031 exchange? So let's say Charlotte, I think it was, when you do a 1031 exchange and then the LLC holds the property for 2 years, can you move into it after you take title to it? The answer is no. Why? Because you just took title to it. You have to hold it for a minimum of 2 years. You cannot convert a property that you did an exchange into your principal residence. When? Here's the answer. You're ready, and I hope you get this. Never, ever. Now, I want you to pay attention to that. Why? Because I want you to let's read this really quick. The new replacement property must have been purchased with the intent to hold for investment. It doesn't say to hold for 2 years. It says to hold for investment, period. Now, in the event, and this is the next bullet point, and this makes all the difference in the world, that there was something that happened that was unexpected, unanticipated, and unplanned. Well, let's talk about what can be expected. We file for a divorce, let's say. But we know that there's then later on we have the divorce. You say, well, the divorce was unexpected. No, it wasn't. You knew this was happening. Number two, something that was unanticipated or unplanned. Well, what can be unanticipated, unplanned, or unexpected? Well, COVID-19 is something like that, right? Totally unexpected, unanticipated. If you've held the property for 2 years or longer and something changes, that's why I underlined the word change. That was unexpected, unanticipated, unplanned. Retirement? Sorry, that was planned. You knew that was going to happen sooner or later. Now, I'm just taking the position right here of the federal government and especially the state of California. But the bottom line is you could have a health change, something that was unanticipated, that you needed a 1-story to move into because you lived in a 2-story and you could move into your rental. Or you could have something like a monetary change where there was a downturn for you and you suffered great hardship. Unexpected, unanticipated, unplanned, but it happened. And you have to do a conversion of that rental into a personal residence. Your CPA may have merit for that. Or how about death? How about a spouse that passes or a divorce? There was no way unanticipated. There are those kinds of situations. What you need to do is never answer this question to your client. They need to go check with that's why I have it in red in big letters, CPA. They need to talk to their tax counsel. Why? Because if they think they're going to convert it in 2 years, they have the intent to do so, and that is not allowable. And the CPA will call them on it. But if something happens and something changes after 2 years, talk to their CPA, see if their CPA is okay with it, do the conversion if they think it is, and then if they ever get audited, they need to go talk to their CPA because it was a tax question. Can I move into a property? The exchange is 6 months, 12 months, 2 years, 5 years, 10 years down the road. It's past tense. So the question is, can I do the conversion? The answer is after 2 years, if it was unanticipated, unexpected, and something changed. So does that answer your question? So you can't buy with the intent to move in. If they figure it out, you're dead. They're going to go back and disallow the exchange, charge you the tax and the interest that you had, that you didn't pay the taxes back then. What was the interest that accumulated on that? That's what they're going to do to you. So be careful, be careful, be careful. Any questions about that? No? Okay, good. Now, I want to talk about relatives. What is the definition of a relative? Oops, I don't know how that happened. What is the definition of a relative? The answer is, it's the people that you argue with on Christmas and Thanksgiving and New Year's. No, Jeff, birthdays, no. That's bad. The definition of a relative is a direct lineage descendant. What is that? Because the government has some very specific feelings or rules, forget about feelings, rules on 1031 exchanges and you doing them with a relative. And people do this all the time. And they can get themselves in a lot of trouble if they don't do it the right way. A relative is a direct lineage descendant. So a grandparent to a grandchild is a relative, right? And back and forth. A parent to a child is a relative, back and forth. Siblings to each other are considered as relatives. Married people are considered as relatives. So let's say I want to do business. My wife owns a property, let's say with my sibling, but she married me and we do a joint tax return and the property is still in her name only. She's still under the related party rules by virtue of the fact that she's married to me and they're my siblings. So it's a straight line descendant. Guess what is not a relative? Your cousins, your aunts, your uncles. Those are not straight line. So therefore, the government will allow you to do that. They're not considered as relative. So what happens if I want to, number one, sell to a related party? Well, the government will permit me to sell to my relative, to my aunt, to my siblings, my children, my parents, whatever, grandparents. I can sell to them and do a 1031 exchange and buy another rental like kind investment property. However, once I conclude my exchange, both me on my new purchase and the relative that I sold to have to wait for 2 years, 2 full years, 24 months before either property can be sold again. If either property is sold within the 2 years, guess what happens? It disallows my 1031 exchange. So I can sell to a relative, but once I acquire and close, we have a 2-year holding period on the property I sold to my relative, my related party, and the property that I bought for myself. Okay. Next question is, can I purchase from a related party? So let's say I want to buy my sister's home because my sister, it's too big for her, or I want to buy from my son or my daughter because my son and my daughter just is a little over their heads in the payment, and by doing an exchange and buying their property, I'll take them out of the soup, right? Can I purchase from a related party? The answer is no. The only way you can buy from a related party is if the related party is also doing a 1031 tax deferred exchange. If they are not, then I cannot buy a related party's property. So if I'm buying their home because they're underwater or it's too big for them now, whatever the reason happens to be, guess what, folks? You can't do a 1031 exchange on a personal residence or a second home or a vacation home. Therefore, it's not allowable. So be careful. You cannot buy from a related party unless they are also doing a legitimate 1031 tax-deferred exchange. So I just want to remind you what your parents told you when you were younger. Don't do business with relatives. Maybe they knew something about the code section. Who knows? But the bottom line is there any questions about a related party? Because that's the difference between a qualified versus a disqualified exchange.
Phil, I have a question again. I'm sorry.
Sure, Charlotte.
It doesn't. So I have a client that has a 68 unit apartment that wants to sell and then purchase about 12 single family homes to then build ADUs on. And so I'm just wondering though, was that qualify as still, because it is doing a 1031 exchange out of like a huge, but then, you know, a huge one piece of property, but then he wants to divide it up into multiple single family residences. He's not buying from a, you know, a family member, but, you know.
Did you say is or is not?
He is not purchasing from a family member. It would just be going from like an apartment complex into single family properties.
The answer is yes.
Oh, good.
As long as he acquires for roughly equal or greater than the sales price of what he sells for minus the non-recurring closing costs, moves cash and debt. We'll try to cover that a little bit later down the road today if we have enough time. But the bottom line is, or you and I can speak personally, you know, this week sometime about it. But the bottom line is that you can acquire multiple properties in a 1031 exchange. That's not a problem. The bigger question is, if he wants to build ADUs, is he planning on using the money from his sale? Or is he just going to buy the properties and then build with his own funds later on? That's when you get into something called a build to suit exchange. And if we have time, we'll try to talk about that, because this detailed stuff when he gets into these kinds of questions are great questions, legitimate things that happen. But the bottom line is, you know, we're going to try to crunch as much as we can in this. And there is a way of doing it called a build to suit exchange. And if we have time, I'll try to cover that today.
Phil, we also have another question from Ruth. She wants to know, what if the relative's property is a rental?
Well, as long as it's a rental property and they're doing a 1031 exchange, I can buy their property from them. But they have to do a 1031 exchange. Make sense?
Ruth, does that answer your question? Okay.
Phil, can you hear me?
I can, Connie.
Hey, thank you. You're just so valuable that I actually postponed a trip to Oregon because I did not want to miss this. You're our to-go guy when we're ready to do a 1031. I don't like questions that are so personalized that everybody else is yawning, but so I'm hoping that other people may get some value out of whatever you tell me. The scenario is my daughter and her husband are getting a divorce. They both own property X, and my daughter may not be able to buy the husband out and have to leave her dream home. What if we do a 1031 on one of our investment properties and buy that and rent it to her?
Okay, that's a good question. And here's the answer. First of all, you have to have a divorce decree that separates them and a finality of the marriage. And that's at the end of the divorce. Once they're officially divorced, he's no longer a related party to you. Now you can buy out his portion, but you can't buy out her portion because she's still a related party to you. Therefore, you can have title as tenants in common with your daughter and own his portion, no longer related to your daughter because the divorce is finished, and have title with her and rent your half of the portion of the building to her. That would work. I would recommend that you run that by your CPA, which many CPAs may not know the answer to because they haven't been in my classes, or they don't know this much about the exchange that specifically in this kind of an advanced mode. But the
Okay.
bottom line is that could certainly work if you do it the way I just mentioned.
Okay, thank you.
You're welcome. You know, actually, what that question was actually significant that Connie just asked, because I get a lot of questions with people who are in the midst of a divorce, who want to split things up and do an exchange and just buy something for themselves. They can't unless they have a divorce decree, at least at that point. Some kind of finalization of the assets that are currently owned by the couple. And if there's no decree and there's no finality to that via the decree, then they're married. They have to buy together as opposed to individually. So that creates a really big problem. So for sure, they need to talk to tax counsel, but the bottom line is that you need that decree at least. Any more questions about the related party thing? I usually get a lot more questions on that one.
I have a question.
Yes, Jess.
So pardon my ignorance on this, but going back to her question, is there, what is the proof that it is her daughter leasing it? I mean, who's going to pull up the lease records to show that it's her daughter leasing, as opposed to someone who's not related to her?
Well, remember, the lease part has nothing to do with it. What matters is who owns the property. And if Connie owns the property, at least half of it, she has to declare that rent on her Schedule E and depreciate her half of the property, right? Plus, the county assessor is going to reassess the property for property taxes because there was a sale of half of it. Remember, they can't buy the property if she's still married to him. But if the marriage is over, it's finished, and not emotionally or mentally, but legally. Then what happens is he's no longer a related party. They can buy out his half, and then they can lease out the other half to her or whoever else is going to rent the property. Let's say their daughter decides to lease out the property as well, and she moves out of the property. Then they would get half the lease, half the rent, and the other one would, the daughter would get half the rent, right?
Got it.
Okay. I hope that makes sense.
It does. Thank you.
You're welcome. Anybody else on this related party? I tell you, these relative things get you a lot of trouble. Sorry, laughing at my own jokes. Okay. All right, we'll move on. Let's say you do move into the property. All right. Let's say you do a conversion. Let's say you do a 1031 exchange, you buy a property and something happens, and you do have to convert it into your principal residence. The question is, can I sell it and take the principal residence exclusion up to $250,000 under the 121 exclusion for a personal primary residence? Or if you're married, filing a joint return with my spouse, up to $500,000. The answer is it's twofold. Number one, the first change occurred in October of 2004. And this is what Congress said. They said, after you exchange, if you really need to move into the property for a legitimate reason, like we just talked about, unanticipated, right? Then you may claim the 121 principal residence exclusions if, number one, you have actually had title to the property for 5 years. What they're trying to do is slow it down so people can't just do a 1031 exchange, move into the property, and then sell it. All right, so they say you have to have ownership for 5 years. And number two, it has to be lived in as a principal residence for 2 full years, 24 months. All right. But something changed from 2004 when Congress made this law in October to the new Economic and Housing or Housing and Economic Recovery Act of 2008. This was also passed in October by Congress back then in 2008. It went into effect on January 1st of 2009. And this is what the government said. This is really important. Number one, it does allow for a conversion of a property that you're renting, but it also allows for a conversion for a second home or a vacation home. So I live down here in LA County, but don't hold it against me. And let's say my wife and I own a property in Newport Beach. Pretty nice, huh? Vicariously. So we own this property in Newport Beach, and it's been a vacation home. Or I rent it out periodically, whatever. But the bottom line is it's not my principal residence. It's a vacation home or it's a rental. And we decide to sell our Whittier home, take the $500,000 of exclusion, right, on the sale of our home. And then we decide to convert. What's a conversion? Is it one of these things? No, it could be, but that isn't really what we're talking about. The conversion means that my wife and I move into our Newport Beach property. And we convert it into our principal residence. And now we live in it for 2 years. Can I sell the property after 2 years and take the $500,000? Now remember, it was either formally a property I exchanged into, or it was a rental, or it was a second home or vacation home. This is what Congress wrote into this Housing and Economic Recovery Act. Boy, you talk about an oxymoron, because this is what they said. They said that if you do this conversion, that your CPA has to go back to the year 2009, beginning January 1st. They have to count all the years from 2009 to the close of the sale of this property that you converted. Look at all what they call the non-qualified years. And then they will look at the qualified years. What does that mean? It's the years that we actually lived in it as a principal residence, the whole 2 years or longer. They're going to come up with this really hair scheme type equation that the government came up with. And basically what it says is that whatever the ratio came up with and all the equations that they have to come up with, a numerator and a denominator, it's just really confusing. They will give you a fractionalized part of the 250 or a fractionalized part of the 500 based on the usage of the property, which means if you converted a property that had a low basis and a higher gain, and you were anticipating getting $500,000 out of it, you're in real trouble, because you may just get $100,000 of gain exclusion, which means the other $400,000 on the sale of that property in Newport, I have to pay taxes on it. That cost me $150,000 minimum just to sell the property in taxes, minimum in my example. So the whole point is this: when you convert a property you already own, whether it's a rental or a second home or vacation home, which are basically the same, and I move into it, and I go to sell it, thinking I'm going to get that 500 or the 250. Think again. Talk to your CPA first. This can be a problem. So be careful, be careful, be careful. Any questions about this? My suggestion is, don't tell people because you just assume it's their principal residence and it's always been their principal residence, that they'll automatically get to 500,000 exclusion, married couple filing joint return, or single person 250. If I were you, I would say up to 500, up to 250, and let the CPA do this part, because it's really complicated. And if they're wrong, you're wrong, and you accidentally gave them bad information, I hope your E&O is paid up because you're going to need it. Does that make sense? Be careful on tax advice. So watch out for this Housing and Economic Recovery Act. Here's another question I get. This is big. Let's say I bought a principal residence with my wife, when we were younger, and we wanted to raise the kids in it, right? So we bought it for, let's say, $200,000. But now it's worth $1.5 million after all these years of inflation and people wanting to buy, just watching the value go up. Well, the thing is we've always lived in the property, so I know I can get up to $500,000 of capital gain exclusion because I'm married to my wife. And the title shows that we're both on title. The husband and wife is community property, or rights of survivorship, or in a trust. So what happens is that if I sell it for $1.5 million and I bought it for $200,000, that means I have what? That's like, well, let's do the math. That's over $1 million gain, $1.2 million gain. And all I get is $500,000 off of it, which means I'll have to pay taxes on $700,000 if I sell my principal residence. Well, guess what happened on February the 14th, Valentine's Day, in 2005? The IRS gave us a love gift for Valentine. And this is what they said. They say you can convert your principal residence into a rental, rent it out for 2 consecutive years, and then sell the property. If you do this, the government will allow you, because it's been rented for 2 years, you're declaring the rent, you put it on your Schedule A of your tax return, though it was a personal residence all those previous years, you can treat it as a rental and do a 1031 exchange, but they will also let you double dip and take the personal residence exclusion as well. You see, prior to 2005, it was one or the other. Because it was a rental property, they'll let you do the exchange and you'd have to exchange all the cash into the acquisition and buy for equal or more. Or they would let you take the $500,000 because you did live in it 2 out of the last 5 years. And as long as you close escrow before the end of the 3rd year, you've lived in it 2 out of 5, which means you can still take the 500, but pay the rest of it, the $700,000 in capital gains taxes. And that is going to kill you. But now on this love gift that they gave us back on Valentine's Day in 2005, they'll actually let you combine the 2 together and take both. It's an incredible tax deal. I hope the government's not listening, because I think they've forgotten that they did this. Actually, it was the IRS who actually did this. Congress and the president had nothing to do with this. This was something that the IRS did. So it's still in the books. And I actually have a flyer, a mailer, for those of you who know of people or have a farm package. And I know Placer Title can provide you a farm package of people who've owned their properties, for 25, 30, 35, 40 years, their principal residence. This may be a nice marketing letter because perhaps their gain far exceeds the $500,000 and they could rent it out, and then sell it, and then do both, an exchange plus keep the 500. It's an incredible deal. Any questions on this? Nope. Okay, good. Now, a lot of people ask me, Julie, I just saw your picture on here. They go to other states like Tennessee, Arizona, Idaho, Nevada, Texas, all kinds of places. Can I do an exchange outside of the state of California on property I already own? The answer is yeah. California tried to stop it. They said, well, we'll let you defer the federal tax. Yeah, thanks a lot, state of California, for letting me defer the federal tax. But they said you couldn't defer the state tax. And they wanted to put that, unless you bought back in California again. They were trying to stop the flight. So guess what happened? We petitioned the Congress and we stopped the state. They could not mandate this because it's a federal code. They have to do this. So guess what California invented? It's called the California Clawback Rule. And I want to go over this with you because this is a big deal. California Clawback means this. I'm doing a 1031 exchange, but I want to exchange out of the state of California. Now, when you think of a claw, well, let's pretend we had the California state flag. What animal is our mascot on the California state flag? The answer is a bear. The bear has a claw. It's the best way to remember it. The claw can take and claw back. This is what the clawback provision says. If an investor chooses to exchange outside of the state of California, The state wants to keep track of that property because if it is eventually sold, the state wants to claw back its a gain from the original sale time. So what happens is California created a form. The form is called in red, Form 3840. If you exchange out of state, the state of California requires by law that you file this form every year, that you still have that property and that you haven't disposed of it. If you don't submit that form, the state of California considers it as a done deal. It's been disposed of. Therefore, they get to claw back. And they're gonna claw back their state tax. So all you have to do, and it's just a form. Your CPA will do it every year. It's called 3840. It allows the state to keep track of that sale unless the property is disposed of in a taxable sale. But what if it's disposed of but not in a taxable sale? What does that mean? Well, let's say you sold this property in California and you bought one in Idaho. And let's say 10 years down the road, you want to do another 1031 exchange and sell Idaho and buy this time in Hawaii, my favorite. You want to buy something in Maui, for example, or Kauai. Those are two favorite islands. And you want to buy a rental there. Can you do that and still defer the tax? The answer is yes. You would just indicate on that 3840 that each year that you file it. But in the year that you sold the Idaho property in, you would just check the boxes that says that you have sold the property and done another 1031 exchange into Hawaii. And then each year in Hawaii, when you do your tax return, you have to, in that 3840, you just include that Hawaii property. They can't claw back at you. When you pass away, if your property is in a trust or another vehicle like that, guess what? The state may not be able to claw back at all because of the stepped up basis, which means the state is out of luck. They can never get that money.
Phil,
So, yes.
can they claw back if it's in an LLC?
Yeah, absolutely. Because the LLC can do a 1031 exchange.
Okay, that's what I thought. I just wanted to make sure.
Yeah. No one's ever asked me that, but I don't see why not. Because again, I'm not a CPA, but the bottom line is if the LLC owns the property and you're the shareholder of the LLC, guess what? Guess who pays the bills? The shareholder. So the bottom line is, yeah, they would claw back. I'm almost positive they would. If I find out differently, I'll let you know.
Phil, I have another question.
Sure, Jess.
So, death and taxes. So you're saying that the only way to avoid the California clawback is death. Is that correct?
Well, yeah, as long as you have that entity, and this is where you want to talk to your CPA or your estate planning attorney, that it's in a vehicle like a trust, where, for example, my trust can be the shareholder of my LLC. How do you like those apples? So I can just simply have the trust as a shareholder. And as a result of that, the basis is stepped up. So when the basis...
If the trust is dissolved, then is that the same as death?
Well, the trust, what happens is, okay, let's back it up a little bit. I get a trust for 3 reasons. Number 1, void probate. Number 2, distribute what I want to who I want when I want it and when I want them to have it. And number 3, to get a stepped up basis. So what happens is, if it's my wife and I pass, like it's a 2-member trust. So it's a husband and wife is, we're both the trustees, we're both the trustors, and then we have a successor trustee. What happens is when we pass, or if I pass, my portion of the trust dies. And what happens is my wife gets everything at a stepped up basis. So she can just literally sell the property and pay nothing, even though she's a co-trustee. So talk to your CPA, but more importantly, your estate planning attorney, to make sure that the trust works for you the way you want it to. Because if I was by myself, let's say I was the trustor and the trustee, and I passed, guess what happens? They have to start another trust or another tax ID number. Why? Because as soon as I die, the trust is over. So the bottom line is, is that you're going to have to work with your tax people to make sure that you can get everything out of the trust, which is very simple. And that's why you began it in the first place. But the bottom line is your tax people and your estate planning attorney will hold your hand and walk you through the process, because that's their job, to help you with it as soon as the trustor and the trustee passes.
Phil, do you know if other states also have this clawback or something similar? Like, are there other states we should avoid that would continue to encumber our taxes?
That's a good question. I do know that there are between 8 and I think 14 clawback states. California is one of them. I would have guessed that New York is another one, but who knows? I don't know who those states are, but that's a good tax question for your tax people, especially your estate planning attorney, because I would think that they would know. Hey, by the way, not all states are community property states either. Remember that. Any other questions on this? Okay, so be careful when you exchange out of state. Just fill out the form. That's all it is. Submit it with your tax return. You'll be fine.
Well, I have a question.
Go ahead. Nicole?
Yes, thank you. I have a.
Pleasure to talk with you again, by the way.
I know. I miss seeing you
Thank
at
you.
the
Me
office
too.
and everything, but that's another conversation.
Yeah.
So my husband and I now have a trust in perpetuity. So when you were talking about when you as the trustor and trustee pass away, that's the end of the trust. What if it's one of those, which this is kind of new to me.
Yeah, that's a good question. I don't know. I recommend that. Did you have a trust in perpetuity right now? Is that what you did?
That's correct. We had our attorney update our trust, and when he did that, he converted it into what's called a trust in perpetuity, which we didn't know existed until he explained it. And as it turns out, my mom has the same thing, so it's really confusing because someday when she passes, she's got her trust in perpetuity. We have ours. I don't know how that works, but that's a different question.
Yeah, that's a great question for your CPA, or I'm sorry, for your estate planning attorney, because I'm not sure. I'm exchanges are my bailiwick, but the trust is not. I know enough just to give you the information that you need to know as it relates to exchange. We call it swap till you drop. You keep doing 1031 exchanges, and then eventually when you pass, you're in the trust that your heir gets a stepped up basis. There are other ways of doing it. The trust is not the only way, but I like the trust the best personally. But that's a good question for an estate planning attorney.
And can you define one more time the stepped up basis? Clarify that again, please.
Yeah, for example, remember back in the old days when we took title to the property as husband and wife as joint tenants? What would happen when somebody would pass away during that time? Let's say I were to pass away, my wife would inherit our property with a stepped up basis on my half, but not on her half. So she would maintain her old basis based on what we bought the property at. And then whatever the fair market value was on my half, she would get that. So the CPA would have to kind of blend the two together. So there was a split basis. When California came up with language with rights of survivorship, and with the trust, what it does is automatically gives a full stepped up basis, not a half stepped up basis, to the surviving spouse. And that became very popular. Obviously, because they turn around and sell the property, they have no gain because of the passing of the one spouse under the right language or the trust. So that's why I think everyone, if they haven't already, should probably just review this with your CPA or an attorney, especially a real estate attorney or an estate planning attorney, to make sure that your vesting is good to give the surviving spouse a full stepped up basis for the heirs.
And also, I want to jump in here real quick. I know this doesn't have anything to do with exchanges, but if you do have properties that are in a trust, whether it's your personal or you're dealing with somebody that is selling a property in a trust, make sure they have a bank account in the trust, because I bet you 8 out of 10 escrows we close do not have bank accounts, and people think we can just turn around and write a check as to them and individuals, and we cannot. So, and as you can imagine, if you do have a death that's involved in a trust, it becomes very, very hard to fix the problem after the fact. So there's a lot of reviewing from the banks, and certain banks are very sticklers on even opening up trust bank accounts. So just a reminder for any of your clients that have properties in the trust, make sure those are set up that way as well.
Julie, that's a good point. And I'll tell you another thing that they can do. When you take the successor trustee, remember, they have to start a whole new social security number for the trust, because that person just passed.
Mhm.
And they would also start a bank account for that trust, with the new tax ID number. So the bottom line is that they're going to have to do that as a successor trustee. So again, pre-planning with a good estate planning attorney is the best thing you could do. I mean, what is it today? Like $3,500? It's nothing. I mean, probate costs what, $400 an hour for 6 months, a year, 2 years? It's insane. Why would you want to do that? Trust is the best way to go, in my opinion. That's a good point. Thank you for sharing that.
Okay, so we have a question from Paula Martinez. This is a great question. She says she
Go
has a
ahead.
client who is ready to close escrow on a 1031 exchange in Bass Lake, which is under evacuation. If the home should burn down and we are past the 45 days, will they get an extension?
It depends. Just recently, the governor declared certain counties in Northern California as disaster areas. The second thing that has to happen is the President of the United States has to go with that. And in this case, the President did. Then FEMA has to get involved. And then lastly, the IRS has to make a declaration. If you go to the IRS's website, there's a number of counties. I'm trying to remember off the top of my head because I'm not up there. We have a rep that's up in the Bay Area in Sacramento, but like Yolo County and just a lot of those other counties up there that were considered as disaster areas, the IRS gave a 120-day extension to the 45 days and 120-day extension to the 180 days if you are a victim of the fire. And how they define that, I do not know. The CPA will probably be able to help out with that. But you just go to irs.gov and see if you can find the, because it's a big website. It'll give you links to, you may want to type in something in the search engine like California fire extensions or California disaster extensions. And the IRS's website will then name those states in that. So that's what I'd recommend you do. And by the way, sometimes it says the disaster has to be between this date and this date. So if you're in an exchange and your exchange is beyond that date, you may not qualify, or before that date, you may not qualify. So that's another thing that they have to check it out with their CPAs, because their CPA has to be able to document that on the tax return, especially if it takes them into next year.
So Phil, just real quick, I just want to let you know it's 11:18. Just
Wow.
we could be here all day.
No, I could. We could
Are
actually,
you ordering lunch?
I was talking to this guy. I said, gee, we should use like, what is those food delivery services now? Yeah,
Uber Eats.
Yeah, Uber Eats and all those other ones, and do a lunch thing. That's a great idea. But we've got so much I can talk about. I mean, we can do part 2 of this extended stuff and to go into other things. But the bottom line is that if I just want to talk about, this is a big deal. What is a reverse exchange? A reverse exchange allows you to close a purchase before a sale. You know that the federal government doesn't look at a 1031 exchange when you open escrow? Nothing to do with it. It's all about the close of escrow. The sale closing the purchase closing. But what happens if you have, and I've been getting a lot of calls on reverse exchanges lately because of inventory. I found the right property. The seller can't wait. In fact, I just got one from Ventura County yesterday. He calls me up. He said, I bought a property up in Massachusetts. If I didn't pull the trigger, I couldn't have bought the property. They were gonna, so I went in all cash and I acquired it. Can I exchange my proceeds of my sale into the acquisition I just bought? The answer is no. Why? Because if you buy it and close it, the bottom line is you own it and you can't exchange with yourself. So the government won't let you do that. So you have to go through this reverse exchange. In his case, now you might find this interesting because we just talked about this. He said, well, how about this? I put it in my daughter's name. Can I buy it from my daughter? The answer is no. She's a related party to you. You can't buy from a related party. And unless she also does a 1031 exchange, but if she's going to just close escrow and then turn around and flip it over to you, that's an agency agreement that you have with her. That's illegal. You can't do that unless she's licensed. So the bottom line is this is not a reverse exchange either. So what is a reverse exchange? A reverse exchange is when a company like ours who facilitates 1031 exchanges will set up a holding corporation. You see in red, this is an EAT. EAT stands for Exchange Accommodation Title Holder. So we set up a title holding corporation that will take title to the property you're buying if you're going in all cash. If you have to finance the new property, the lender won't let us hold title to it. So what we will do in that situation is take title to the property you're selling the day before you close your new acquisition. Are you with me? So the EAT has to hold title to the new property or the property you're selling the day before you close your new purchase. So you're not in violation of holding two properties and trying to buy from yourself. That makes sense? So once whichever property goes in this EAT, you're going to have up to 180 days to close escrow on the property you're selling because you closed the purchase first. So you only have 180 days to close your sale. Now that may not be a problem, but if your buyer falls out, you better make sure you get another buyer in who can close within that 180 days because that's what the government requires in a reverse exchange. It's closing a purchase first and then closing the sale up to 180 days later. Now, here's the big question. Where is the money going to come from to buy it? You haven't sold anything. And didn't we just say earlier that all the proceeds from the sale have to go into the acquisition? The government will allow you to float money of your own personal funds. And or you can get a swing loan, a bridge loan, a line of credit, a conventional investment property loan. Whatever it is that you're going to get, whether it's all cash or some cash and another loan, you could even use hard money in these situations. But the bottom line is the federal government will allow you to do a 1031 exchange, close a purchase through the accommodator on the acquisition. Will either hold the title to the new property or the day before you close your purchase, the title to the property you are relinquishing. And then whichever one we're holding, the sale has to close within 180 days from that point. That makes sense? That's what a reverse exchange is. And when the sale does close, any personal funds that you took out of your example, your savings account that you wired in for the acquisition of the property, you're allowed to be reimbursed of those funds because it's a reimbursement for the acquisition. It's kind of like just like EMD. If you put EMD money into the acquisition without the benefit of the accommodator having money in the holding account because you couldn't close the sale fast enough, you would be allowed to be reimbursed that EMD money from the proceeds of the sale. It's just the same way like this. You're just simply being reimbursed. Outside of that, you're not allowed to take any cash out of a property. And if you got a swing loan or a bridge loan or a line of credit or whatever, those can be paid off. In a reverse exchange only, if you have extra cash left over from the sale, you can do a principal pay down on the up leg replacement property. Just make sure that the loan you get, it doesn't have a prepayment penalty on it. Because if we try to do a principal pay down with that'll cost you if there's a prepayment penalty. So you don't want that.
Phil, do you see a lot of these reverse exchanges happening?
More now than ever. More now than ever.
Here in
Well,
California or
inventory.
nationwide?
More in California, though we have seen them nationwide, but far more in California. Inventory. Wherever there's a lack of inventory, there are reverse exchanges. Why? Because I know I can sell. The question is, I only have a 45-day limit. Can I buy? And what if I don't find the right property? Do I want to settle in on something I really don't want? Or am I willing just to pay the taxes and move on? So those are big questions that only the taxpayer can answer. Not only are you floating money, but what happens is our fees go up. Ours meaning our industry. A reverse exchange is very costly. We have to set up a holding corporation. The paperwork goes from this thick to that thick. We have, in addition to that, our legal department is going to do all the documents. The client will be working directly with the attorney and her staff. So the bottom line is that, and then when it's finished, that holding corporation, we don't commingle. Some companies do, but we don't do that. We never commingle properties in a reverse exchange. Remember the LLC when I said there's multiple properties in there, they can go after everything? What if one of those properties, somebody tripped and fell and hired an ambulance chaser or attorney, and is going after the owner of that property? Well, guess who owns the property? That entity, which is that corporation or that LLC. That means all the properties will be affected by the lawsuit. That's why we never, ever commingle properties, either in the bank when we're holding money or properties in the holding corporation when it comes to reverse or build to suit exchanges. So the bottom line is we have to be very careful to protect those funds. And then we have to dissolve the LLC when it's finished. So it's no longer in use. The tax ID number is gone. We have to file the tax return with the state.
So another question. So another question in regards to that, because properties are moving so quickly, how long does it take to set up that holding corporation? How long of an escrow should agents plan on if this is what they're going to do?
Well, depends on the seller of the up leg, right? But the bottom line is we always have we have a number of LLCs. We keep an inventory of them for the exact reason that you just asked. So what happens is we always have an LLC which has never been used, that we've already set up with the state of California. Or what we use is we don't really use LLCs, we use corporations. We have a corporation set up. We go to the federal building and we get everything set up. So we just want 1 to 2 weeks minimum before the closing of the purchase to set this thing up as a reverse exchange. We have enough manpower that we can handle it. 1 to 2 weeks notice would be really helpful.
Okay, great. So just in light of time, it's 11:28, and I know how busy everyone is.
Okay.
And I know, do you have a lot more things to share? Maybe we should do a part 2 to this advanced class?
Yeah, we can do it. Like, let's say, won't need an hour and a half, but I can do it in an hour.
Okay.
And we can you and I can set up a part 2, and then you can e-blast everybody who's able to attend this today, or the other ones who wanted to attend who couldn't, can come back for part 2.
Yeah, because
Go ahead.
Well,
I was going to say we also could let everybody stay on who wants to stay on if we want to just finish off the slides, and then if people want to jump off, we won't take anything personally, and then Phil can share his information for any specific other questions anybody may have.
Okay.
But we've had Phil on. This is the 3rd time he's come on to host the 1031, and we've kind of incremented up each time. But I mean, I think I say how many more slides do you have, Phil?
I probably have about a good hour to go.
Oh, wow. Okay.
Yeah, so I don't think continuing on today would work for me either, but I am definitely open to doing this again. And it's just a
Is
matter of
there,
scheduling.
so anybody that's, still here, and we still have 28 participants. So if we have any specific questions, do you want to just do a Q&A for, 5 minutes or 10 minutes, and then
Next
we can
15
pick up?
minutes or so, if you want to do Q&A, it'd be my pleasure to help.
Okay, it looks like Nicole has her hand up. Nicole, if you want to go ahead and unmute yourself and ask a question.
Actually, he already answered it, so that's an
Oh.
old thing.
Oh, okay, sounds good. All right. So real quick, until someone asks a question, maybe you could just touch briefly on marketing, lead generation. What could our agents and our lenders and our commercial folks on here, how could they go out and market these investors?
That's a good question, Cheryl. What happens is you need to, for them to market them, they have to know who they are and what properties they own. Well, guess where they can get that information from? That you'll never believe it. From you, from Placer Title. You can give them farm packages on anything. Condominiums that are absentee owners that have been rented out for at least 10 or 12 years or longer. Also, you can get farm packages on single family rentals that have been rented out, for at least 10 years or longer, or at least have been entitled for 10 years or longer. Units, whether it be 2 to 4, 5 and above, or virtually any kind of commercial use codes. I'm not sure you know off the top of your head how many use codes there are in the commercial and industrial end, but those are all owned by people who are utilizing the property for business or for rent. They qualify for a 1031 exchange. You could even do farmland, ag. There's a lot of ag exchanges. So the bottom line is that, whatever it is you feel the most comfortable with, you can, Cheryl and your team could go ahead and set up a farm package for your individual agents who really want to know who are these people. Secondly, what I have a slew of marketing letters that talk about all kinds of different items, like what is my rate of return on my property? What happens how do I get the equity that has grown over the years to work harder for me, by maybe releveraging a little bit of that equity or going into other types of properties that are more suited for me at the age I'm at. I had somebody call me up today and want to do a 1031 exchange into a DST. I don't know if you know what that is. It's a Delaware statutory trust. In a Delaware statutory trust, the government will allow you to co-own a very, very large property, like a Walgreens or a CVS. Could be a Starbucks. It could be a shopping center with some big name tenants. It could be a 400 unit apartment building. It could be student housing. It can be a new apartment complex, that they just built up in Idaho. But these properties are all over the US, and the federal government will allow you to exchange into these types of properties, but only as a fractionalized interest. You may be a 2% or a 5% or an 8% owner. You don't have to put it into one of those properties. You could put it into multiple of those types of properties. But it allows you to gain a listing by knowing what's out there. Why? Because the bottom line is that every investor is different. They're going to sell because of different reasons. Some people are going to sell and want to bring their investment properties with them because they're relocating into another place. Others want out of California. Others want to get out of residential and go into commercial. Some want to go out of commercial and go into industrial or into residential. The whole point is you don't know what's happening in those people's minds because they bought the properties for one reason and one reason only, to make money. They did not buy those properties to live in. So their question is, what can I go into if I don't want to farm anymore and I want to go into residential units, or I want to do whatever it is I want to do with my properties, or I don't want to manage anymore. I'm in my 70s or older, and I don't want to deal with tenants anymore. Is there a way for me to go into something that's going to be advantageous to my lifestyle and my pocketbook in terms of cash flow? There's lots of those types of letters that I have that deal with these types of issues that help you create a relationship, to find out what the hot button is for that investor, because obviously the longer they've owned the property, the more they may be thinking about what can I do to re-leverage that equity to gain more cash flow or more appreciation or
Bill?
diversified. Yes.
Hi, I'm wondering if there is some sort of online calculator or app that you would recommend for kind of calculating for our clients what their tax maybe consequences are if they do it different ways, or how we could like basically sit down and show them what the different strategies, like if you take a commercial property and you purchase vacant land, or by, you know, all the different options you were saying. Is there some calculator available for this kind of 1031 exchange?
On some of it, there might be. I know that, for example, one of the pieces that I give out is the cash on equity return. And it shows you, by virtue of the fact that you've owned the property all these years, your equity has gained, unless you use it as an ATM machine, which is possible, I guess. But, and it shows you when you consider the equity in the building, and then you consider the income that the property generates, the expenses of the property, and then how to divide it to show the ratio of income to equity after expenses. What is my personal rate of return? I already have something like that I'm happy to give to you, along with about 15 or 16 other marketing letters of different area that deal with a number one of these issues that I just mentioned. So that would be available to you if you send me an email. If you go to the chat box and look in there, you'll see that I think it was the first one I typed in there. My email address is on there, or better, yeah, I'm going to do this really quick. You see, I had a lot of slides to go through.
Yeah, so Phil, what I'd like to, Phil, what I'd like to do, oh, sorry. You know, we'll go back and kick out to the list of people only on this class, and we can start right where the California class slide is and just move forward. And we can do that like in, I don't know, a week or two while it's still fresh in everybody's minds, so we can finish off the slides for everybody. I'd be happy to.
I'd be delighted to do that. You know, you, Julie, or you know, whoever, just contact me, and Cheryl, probably pretty good at it too. And I'll be happy to set that up. But if you want the marketing letters, there's my email address. Just send me an email saying that all I ask for one thing. Okay, I am going to ask you for something. Promise me you'll use them. That's all I ask. These letters won't do you any good sitting in your inbox. You know, they're not going to do you any good sitting in a file. But they're there to help you to start communicating with people who own rental property in any type of these farm packages that I've already mentioned. So they are available to you. Just send me an email, I'll send them to you. Probably not today, probably the next day or two, but I will get them out to you for sure.
All right. Well, Julie, did you have anything else you want to say?
No, just thank you everyone for taking the time. And what we will do is we will start on that slide. We're going to kick out an email to everybody who is on this call today, and we'll start from that slide that we left off and let Phil finish off the rest of it. And maybe even sometime next week we can do it, like, again, while it's fresh in everybody's minds where we left off. And again, thank you for taking the time, and thank you so much, Phil, for you taking your time.
My pleasure. Anytime. It's always a pleasure to be with you all. And Cheryl, let's really quickly connect on that so we can set up a date immediately.
I'll call you right when we're done.
Have a great day, everybody.
Okay, thank you, everyone.
If you ever have a question, all right? Thank you.
Thank you, everyone.
Bye-bye.
Bye.